Consumer confidence is down for the fourth straight week in a row, and former Bank of Canada Governor Stephen Poloz is saying that there is a tripod of angst in the economy. And we're going to talk about why consumer confidence might be down, what it looks like compared to previous years, and what this all means for you in this video. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, hit that like button so more people like you can see this video, and don't forget about our race to 25,000 subscribers, where when we get to 25,000 subscribers, we are going to give away $5,000 to one lucky winner to put towards their debt, to put towards their down payment, to put towards their savings, or simply whatever they would like to do with it. But in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's discuss what's happening in the economy right now. Q2 saw a lower than expected GDP growth number. In fact, GDP was negative in Q2, and that has led to seemingly some negative connotations and some negative expectations around the economy, at least as far as consumers are concerned. And we have people like former Bank of Canada Governor Stephen Poloz commenting on this. We also have Nanos research showing polls that show that Canadian consumer confidence has been down for the last 4 weeks in a row. And this isn't surprising. We kind of came out of the gate in the summer with Alberta opening up full tilt and restrictions being lifted pretty much across the country to certain degrees and different levels. And then all of a sudden the Delta variant has come and it has kicked everybody's butt for the last couple of months. And it looks like the situation is only going to get worse. And therefore, we're seeing consumer confidence go down. And I want to take you in and show you, as we always do, the headlines on this, show you what people are talking about, and show you the actual data before we get into what this means for you. So first and foremost, this is the article from BNN. Former Bank of Canada governor says economy facing tripod of angst. And when he's talking about a tripod of angst, he is talking about three things. I'll highlight them for you here. And that is high government debt, the possibility that we'll have higher taxes to pay for that debt, which is pretty much an inevitability at some point, and higher inflation connected to that debt, and therefore higher interest rates and higher borrowing costs, which lead to less money in your pocket and more money going towards taxes and paying off the money that the government is spending. So, really interesting comments out of a former Bank of Canada governor. The one that comes up for me that's at the end of this article, and you can go ahead and read it if you'd like, is that he is saying that one of the biggest issues that could face the economy is something happening elsewhere in the world near the end of this pandemic, which would lead us to a further low interest rate environment and further angst in the economy. And that is very much something that could happen, because we saw this back in 2008, 2009, big financial crisis, just as we were starting to come out of it, and we saw, 0.5% to 1% increase in interest rates. We get this pandemic, and here we are back down at low interest rates. Now, as you all know, if you've been watching this channel for any period of time, you know that I'm a big believer that interest rates are probably going to remain low for a long period of time, because we are inevitably going to get positive vibes in the economy at some point, and then we are inevitably going to get recessions and bad things happening, which is going to take a long time for us to climb out of this low interest rate environment, especially when you consider that interest rates, when they're low, have high levels of sensitivity and tend to have a big impact on the economy if they increase, and therefore it takes a very long and gradual time to make small incremental changes that don't tank any sort of growth that you've been experiencing in your economy. So that is very much the take that I have, and only time will tell if I'm correct on this, but we can look back at the 1920s, we can look back at Japan in the early 1990s, and we can pretty much say with reasonable confidence that when interest rates get low, they stay low for a long period of time. But that's not what we're talking about today. What we're talking about is Canadian consumer confidence. So I want to show you, this is the Ipsos poll that is on trading economics. If you go and take a look at that, this is consumer confidence in Canada. You can see that back at the beginning of the pandemic, it was quite low. It came up to higher levels, and then it just started to go back down here. Now that's one poll. So whenever we look at polls, we go, okay, well, that's what one is saying. Is it consistent across the board? And you'll notice that during the election right now, that's a lot of what is going on, is we're looking at different polls and seeing if they're consistent across the board, and they very much have been. This is the one that I tend to go by, which is the Nanos Bloomberg polling. And the way Nanos Bloomberg polling works is they basically survey 250 people per week, and over a 4-week period, that gives you 1,000 people, and it gives you a rolling 4-week average. And that is where we're at right now. In the last 4 weeks, the consumer confidence in Canada has gone down substantially and consistently for the last 4 weeks. And if you take a look at the long-term trend here, this is the Canadian Confidence Index. You can see here's the beginning of the pandemic. Here's where we were at kind of in this middle of summer here, at the beginning of summer, expecting that things were back to normal and everything was going to be great again. And you can see that that is actually considerably higher than what the economy typically runs at and what consumer confidence runs at. By the way, this red line here, this is the 50% mark. And what that means is if the green line is below the 50% mark, then there's negative sentiment in the economy. And if it is above the 50% mark, there's positive sentiment. What you can see is that it was quite high here in the last couple of months, but it has started to come down considerably. And if you go a little bit further on and look at the long-term trends with respect to the pocketbook index and the expectations index, the pocketbook index being how people feel right now financially with respect to the amount of money that they're earning, job security, and those sorts of things. You can see that those numbers have been trending up higher, and they've actually got to the point where they exceeded the previous, 13 to 14 years. And if you look at the expectations index, which is the red line, you can see that the expectations for the economy got quite high at the beginning of the summer as we seemed to believe that we were out of this COVID sort of issue. And at the end of the day, now we're seeing that maybe we aren't really expecting that things are going to be as good as we thought they were going to be. And we're seeing those expectation numbers come down. So what does this all mean? Well, first and foremost is, yes, there was some significant spending in June, July, and that led to higher demand, which led to higher prices for certain goods, along with lower supply. That increased the price increases, which basically saw our numbers for inflation go up quite considerably. And there's been a lot of conversation about whether that's transitory or not. Now, here's the thing, is if consumer confidence starts to go down, people are going to spend less money. That's why less money got spent at the beginning of the pandemic, was consumer confidence was basically at an all-time low. And if people start spending money, that means there's going to be less demand. And regardless of what's happening on the supply side, as long as supply isn't shrinking and shrinking and shrinking even more, that's going to lead to lower prices as goods aren't purchased as frequently, which means that we could, based on what's happening these last 4 weeks, if this continues to be what happens with respect to confidence, we could see lower inflation going into the fall, going into the spring, and that means low interest rates for longer, especially if GDP numbers don't pick back up off of Q2, and especially if we stop spending our money. And we know from the First World War, the Second World War, anytime there's been a major global crisis, anytime there's been a major crisis within a large country like the US, it usually takes 2 to 3 years until consumer confidence is fully restored and people start spending their money again. As of right now, it looks like we may be resetting the clock on that thanks to this COVID variant called the Delta. So what that means is stay flexible with your mortgages, stay flexible with your buying, stick to variable rates for now so that you can lock in some savings. And as interest rates starts to go up, if they seem like they're going to go up significantly, you can look at locking in then, but try to keep as much money in your pocket, create as much savings as possible, create savings accounts for what you would expect to have your payment go up on your mortgage if interest rates were to go up, and start putting money away now so that in the event that that happens, you basically have a rainy day fund to make sure that you can subsidize your payments. And of course, it's always a good idea to have investments and savings and as many assets as possible in order to make sure that if things go wrong, you basically have a way to backstop both yours and your family's financial security. And so if you're interested in learning how to backstop yourself against a financial issue or hardship or higher interest rates, I highly recommend you watch the video from yesterday with respect to how to prepare for higher interest rates. And if not, do me that favor anyways, hit that subscribe button, hit that notification bell, hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next one. Cheers.